Bullish or bearish on U.S. equities for the next 5 years?
Bullish.
Bullish. Great, great.
Definitely. Yeah.
Hope you're right.
I have a thesis about the US. It's cyclical market USA. I wrote a blog post about it. I think, yeah, USA is a very good place to invest your money. I don't invest somewhere else. I only invest in the US.
My guest today, Andreas Himmelreich, has what many investors would consider to be a dream job. He just manages his own money. He has an academic background in factor modeling, and he runs a Substack account called QuantStrike, trading for a sub 1 million account. I want to ask him today about factors, especially about investors, though, who have sub 1 million accounts, which is a lot of investors can make money. So, Andreas, welcome. On a 1 through 10 scale, how would you rate my pronunciation of your last name?
Pretty good, James. Thank you.
I think you're being polite. I think my German teacher, I'm sure, would be ashamed of me, but I did my best. So thanks for joining us today. I like to start with a quick lightning round. Don't think about these too much, just very casual questions. Last movie you saw?
Oh, last movie I saw. I think it was about the atomic bomb. What was it?
Oppenheimer?
Yeah, Oppenheimer. Yeah, I think it was Oppenheimer. Yeah.
Was that everyone says it was good? I don't see any movies. I live in a bubble. Was that good?
It's an okay movie. Yeah,
Okay,
it's
okay
good.
enough. So
Right. Yeah.
maybe if I'm on an airplane one day, I'll watch it. Fill in the blank in this question. I wish more people appreciated blank about me. It's kind of deep, I know.
No, I mean I'm fine. I mean I feel appreciated. That's all right.
Well, that's excellent. Wow, that's you're living a good life, man. Where were you on December 31st, New Year's Eve, 1999?
I was in Berlin.
Berlin. Okay.
Yeah,
Okay.
I just lost a big bet against a good friend of mine, $1,000. We had a race. Everybody, the two of us said, okay, 10 stocks, beginning of '99 until the end of '99, and obviously he picked, all those highflyers.com stocks. And I had some of them, but he beat me.
He was a genius for a while.
Yeah.
Until then he wasn't. That's how some things go. Last question here. Bullish or bearish on U.S. equities for the next 5 years?
Bullish.
Bullish. Great,
Yeah.
great.
Yeah.
Hope
I mean,
you're right.
not every part we can talk about it, but I have a thesis about the U.S. It's cyclical market USA. I wrote a blog post about it. I think, USA is a very good place to invest your money. I don't invest somewhere else. I only invest in the U.S.
Impressive. You're in Germany now, though, even.
Yeah.
So you could invest elsewhere, but you choose the U.S. Well, that's great, and I think a lot of our audience would be happy to hear that. Either living in the U.S. or a lot of people might be in U.K. or somewhere in Europe or Asia who still invest in U.S. markets. That's great. So this is for people who've seen my interviews before. Yeah, I spent time at a fundamental hedge fund, long short fundamental equity. I was director of research analysis at Motley Fool. I ran a dividend selection newsletter for 10 years there. So most of what I think about and talk about is fundamental, like Warren Buffett style investing. I will admit, I do have a secret life. With some academic friends, we designed a quantitative model years ago that sort of not quite a Black Litterman model, but a factor toggling model that sees what's hot. So I have this secret connection to what Andreas is about to talk about. Let me open the door to this, and I don't have as many prepared questions as normal because I want to let you drive this conversation. But for someone just coming into this, factors in an academic sense are basically any reasons people might have for buying or selling a stock, most primitively. And Andreas, you can correct me on this. Price to earnings, return on equity. We tend to focus on those quantifiable ones, but in theory, it could be, location of the company, political party of the CEO's haircut. This wouldn't do well probably, but it could be almost anything. But as human beings, we tend to focus on the easiest stuff to measure and to play with. So it's mostly price to earnings, momentum, things like that. How accurate is that description, Andreas?
Yeah, that's pretty good. I mean, I think factors are pretty important. I'm a systematic investor, and they work especially well in small caps and micro caps. They don't work as well in, the higher you get, into mid caps and big caps, then there is not a big edge in factor investing. But if you go down in micro and small caps, factors work pretty well.
Hence this sub $1 million account you are, those are the people you're writing for in this blog.
Yeah.
So just step back now. If someone just came to the earth from another universe and wants to know about your investing style, how would you describe it in 1 minute?
Well, I'm at Portfolio 123. They have a pretty good platform. They have a point in time database. So every stock that goes bankrupt stays in the database. So your backtests are pretty okay.
Which removes the survivorship bias, which is common.
Yeah, exactly.
People who don't know about there's all kinds of mistakes you can make if you do not know what you're doing. There are a lot of people who think they're geniuses because they've looked and found that stocks with the letter T do great on Tuesdays. And that's just a random historical artifact that's not probably going to continue. So sorry to interrupt, but I just wanted to give that context.
Yeah, and the thing is, especially with small caps, you need to find the right factor combination. For example, I talk to a lot of people who do value investing, and I would say I'm pretty skeptical.
Mm-hmm.
I think you have to combine value and momentum, because otherwise otherwise I would think I'm smarter than the market. I want to see an uptick basically in momentum. And the other thing is that I learned also the hard way that you need to have an earnings tilt as a factor in the model as well. So it would be value, momentum, and an earnings tilt. For example, I had models that worked very well during 2002, 2000, whatever, 11. But afterwards, they decayed a little bit. And you have to ask yourself, do you have the right factor combination? It was sheer luck that this model only valued momentum, picked the right stocks because they had good earnings. But you have to see that you don't have association, but really cause and effect. And I think for small caps, it's pretty cool to have value and momentum and an earnings tilt. And Portfolio 123 has the data for it. So that's a pretty good factor combination. And then in the buy and sell rules, you got to be really careful. So you can have a ranking system with a lot of value factors, a lot of momentum stuff, a lot of earnings stuff. But on the buy and sell rules, you should not have more than 3 to 5 altogether. Otherwise, you're basically overfitting the system. Yeah.
Yep, totally. And Portfolio 123, I'm familiar with it as well. It is a very robust platform. You can certainly do a lot with that. So you point out a lot of the common mistakes. Making things too complicated, mistaking correlation and causality. They're not the same thing. I know some quant hedge funds require their portfolio managers to give an economic justification, some kind of a logic for their model. It can't just be, hey, we don't know why this works, but it works somehow, because those things work until they don't, and often don't come sooner rather than later.
Well, I mean, I give credit to people who just brute force and do whatever, take a big computer and I mean, that can work too, but I don't feel comfortable with it. I really have to say, I want to have really, every factor I put basically into the ranking system. I think about it and, price to earnings, ROE, and all that kind of stuff. It has to make sense to me. And also what I really like in the ranking systems, I really like to equal weight them. So you don't, every assumption that something is better than something else, you basically start curve fitting again. So like equal weight. On the industry momentum, I'm a little bit higher. It could be that I'm a little bit higher on the weightings of the ranking of earnings, but I like equal weightings. Yeah. Mm-hmm.
So let me just back up because I kind of pulled this right into the details. But if someone's watching this saying, okay, factor investing, it sounds kind of quantitative. What's this all about? I'd like you to maybe give a little bit of a broader intro if you can. So obviously factors we talked about, they're not, so if you look at like Warren Buffett's style of investing, he looks for high quality companies. And I think everybody gets that idea. Okay. But we say, well, let's distill that to be a little more specific. Well, what does that mean? Well, he likes the return on equity. He said that's his favorite metric. He tends to be kind of a value guy. So maybe like low PE or, low price to book, high book to market, something like that. Right. if I'm understanding correctly, you've sort of distilled some of these things down into specific factors. You like value, you just don't like value exclusively. You like it paired with momentum, with
Yeah.
earnings. Can you give a little rundown of, like, if Andreas is the director in a movie of factors that he wants to show, what are some of the main players that you want on your stage or in your movie?
Well, Warren Buffett is a great example. What I read about him, he started with basically with smaller caps, and then he had too much capital, so he had to move to the bigger caps. Warren Buffett is into quality at reasonable price, so he's fine with stocks that have a PE of 25 or a little bit higher, as long as the quality is high enough. And and one really interesting thing is, if you look at his Berkshire Hathaway stock, look at it, how fast it comes back.
Mm-hmm.
Very fast. Very fast. So it might not outperform, and it hasn't outperformed whatever the last 10, 15 years, but it's back very, very fast. So quality is a factor that, it might have a 50% drawdown, but in 2, 3 years, he has new highs. That's a very, very nice thing about the quality factor. Small cap value momentum is the same thing. It has super high drawdown. So when the market crashes, basically whenever 50%, you're down 50% too, but it comes back also extremely fast. If you play higher beta stuff, especially what we call long duration higher beta stuff, long duration means winnings, or you think they have earnings in the future, far in the future, so RKK names basically from the ETF, that stuff doesn't come back very fast. It can take years, sometimes 10 years, until they draw on so hard that that you have to have really good risk management, and all growth investors, breakout investors have that. They have a very good market timing system basically, and they don't invest if the market is not really accommodative. And so this is basically also low volatility. Same thing. It doesn't draw on as much. You don't outperform in the bull market. You outperform in the bear market more, and it comes back fast, very fast as well. So you really have to see, as an investor, where you want to play. If you have time, and there are a lot of good William O'Neill, Ken Slim traders, they play breakouts and they play the higher beta stuff, but that is really, I would say in soccer terms, the Champions League. If you don't want to go there if you don't have a lot of experience. So if you
Not
don't
for
have
most investors,
experience, go more with quality, low volatility, stuff like that. Stuff that Warren Buffett, or just buy a stock or cost average into it. So it's really important. And the same thing with small cap value momentum. I mean, I know a lot of people who were very successful from 2003 to 2007 just to have 60% drawdown in 2008. And so you need to know what you're basically doing. So best thing to think about factors is, who are you? What do you want to reach? Which kind of drawdowns can you basically, suffer through?
handle through, suffer through. Yep.
Basically, exactly. And I would say high beta. If you go with RKK names, then you really need to know what you're doing. You have to have a really good market timing, and so I would not recommend it for somebody who's not really into the game.
The way I might frame this for like the real average investor is there's sort of a battle. On one hand, you've got very long-term things like value, like low PE, which academic studies have shown over time that low PE does well. But you could have 5, 7, 8, 10 years where it doesn't do well. Okay, eventually do well. If you've got a million years, it'll do well. Or you've got like momentum stuff, kind of shorter term stuff that sure looks like it's moving at the moment, but it's not going to last 5 years for sure. So it's, which one do you want to kind of anchor? And the sweet spot is probably combining them in some way in different people, different strokes for different folks. Some people want to be more aggressive on the short end. Some people say, nah, I'm going to ride out some of those ups and downs and just take the long-term play. And there's no right or wrong per se. It's just a matter of kind of finding the best risk-adjusted returns for your own, style. Andreas, I believe you have a presentation or a few slides you wanted to walk through. Happy to have you open that if you can. I believe this platform makes it somewhat easy.
Okay, can you see the
There we
screen?
go. Yes, it's popping up. Yep, popping up on my screen.
Yeah.
There we go.
So my subject today is market and strategy timing via network momentum. This is, as I said, is especially important if you're into higher beta investing, but also with small cap value momentum. I mean, small cap value momentum is strong also in difficult markets, but if it gets really difficult, you're going to trot on with the market as well. So what I'm basically doing, I define a strategy book on portfolio 1, 2, 3, and I'm either hedged in difficult markets or I'm basically not hedged. So and I'm doing this with this market timing strategy. So here's the blog. You can, it's on Quadrants at substack.com, and you can, it's all for free. I mean, I have some paying subscribers, but that's just because they want to. I will let this for free for whatever, one or two more years, and then I'll see. But right now, I want basically the stuff also have a little bit of out of sample. And that's the reason why it's free so far.
That's great. They like you so much they pay, even though they don't have to. It's like a donation.
Yes, kind of a donation, yeah.
Yeah.
But usually my stuff is free, yeah, right. Okay, so network momentum across asset classes. There are two papers I'm referring here. As I said, I have an academic background. What I like to see is a paper or papers on the subject, and basically practitioners who are using that stuff at the same time. If they know or not, that paper exists, but I know a lot of people, and so for example, network momentum, a lot of people use, right? And then factor momentum as well. All right. Okay, here are what I call the quads. The quads go from from 0 to 4. And quad 1 and quad 2 is basically risk on, and quad 3 is kind of risk off. You still can play energy names here, and quad 4 is clearly risk off. So whenever there is a quad 3, I'm usually hedged, and when there is a quad 4, I'm usually hedged as well. So this
and risk on, for someone who's just very new to this, it's when the market is more okay with risk. Like a lot of the past 13 years, we've had kind of a risk-on market. People are okay to take big bets on riskier, biotechs or whatever. Risk off is when they want to go back to treasuries, to safe dividend stocks, things like that.
Exactly. Right. So I'll show it in a minute live on my platform, basically.
Oh, cool.
So why market timing? The thing is, I mean, I went down the rabbit hole very deep, and I tried to find strategies that work all the time. That's just really hard, and I think it's not possible. So I mean, you worked at a fund long short, that can be one approach, or you have a strategy that you click in the moment where the strategy fits basically to the market environment. So for example, cancel investing from William O'Neill needs a risk on environment. It's a growth investment. It needs a quad 1 to 2. Shorting strategies work best in a risk-off environment, obviously, in 3 and 4. And ETF strategies can be implemented with that. So whatever, you could buy gold in a quad 4, or you could buy XLK, which is tech, in a quad 1 and 2.
Do you buy more ETFs or stocks in general?
You can do both. I mean, canceling is discretionary. You select your stocks and you wait basically until they have a specific chart pattern, and then you wait for quad 1 and 2, and then you can play that strategy. Usually, it's like there when my quad signal, a quad 3, canceling traders are usually out of the market a week before my signal. So they're very, very good timing it. And as I said, I use my small cap value momentum stuff with this hedging and no hedging timing, just to make sure that in a bad environment I'm not running into a 50% drawdown. It might still be a 15 or 20% drawdown, but to mitigate the cap curve a little bit. That's the aim here. Okay, so that's an example of a small cap value momentum system, and it's hedged all the time. So it has, it has 50 stocks in it, and as you can see, it makes 23% in a year. Very nice. It's very capacity constrained. So if you run a hedge fund with 100 billion, don't talk to me. I can maybe manage 3 million with it, but not more. So,
but that's good news. That's good news for the average investor, right?
Yeah,
because these guys can't play in that sandbox.
Exactly, they can't, and that's the reason why this edge still is there, and it's likely they're in a even in the next 10 years this will not go away because the big institutions can't buy those stocks, basically, right? And that's the same strategy with unhedged. So as you can see, it's 41%. But the drawdown is 50%. So that's the reason why a lot of people do not play small caps, because they have really high drawdowns, right? But as I said, if you can switch off between this and this strategy, that's kind of the aim of the micro quads or the network momentum I'm providing here, right? So quad 1 would be, as I said, risk on. It's all basically tech, a little bit of higher beta cyclicals like housing, stuff like that. And in quad 2, the same thing, but with energy names in it. So a lot of people say, there's no market environment where energy and tech can go up at the same time. That's not true. They can go up at the same time, and if both show basically, momentum and relative strength, that's a quad 2 environment. It's usually when GDP is going up and inflation at the same time. Then you have quad 2. On quad 1 is basically GDP going up and inflation is going down. And quad 3 is GDP is going down and inflation is going up. And quad 4 is where both go down. So I don't look at those macro stuff numbers because I think the market is front running the data, but it's still a good reference, basically. Why is something basically priced in. And the rule is also, if you want an ETF strategy, wait for it until it's bullish trend. So, for example, TLT was not bullish trend the whole year. It just turned bullish trend, I think, this week. And if there would be a quad 4 environment right now, it would be a long. That's kind of the idea, right? Okay. Yeah, that's kind of an example of an ETF, probably uranium. It's kind of a quad 2, quad 3 play. So as you can see, quad 3 hit here, and then it just is a very good exposure in a quad 3 environment. All right. So yeah, how to. So again. I was playing with factors a long time, and I tried to time them, and until I found this paper, I was doing miserably bad at timing them, because there are not a lot of factors that time very well. So if you try to time value, good luck. It's just not.
It's notoriously hard to time factors. You'll hear people talking about that. Yeah, I have this factor momentum strategy, but it's a lot easier to say than to do.
Yeah, but the thing is, there are factors that trend very well. Four factors, and that's the paper about it. And high beta is doing really well to the upside, to the downside. So if you have higher beta stuff, having after 4 weeks, and that's the interesting part of it. After 4 weeks, higher beta outperformance and momentum, and when the market pulls back, relative strength, you have a signal, right? The same thing with the residual variance. It's nothing more than a stock or an industry group is doing something else in the market that cannot be explained by the beta, and basically by it's doing something else than the market. So, for example, a stock is breaking out, even the market is down hard at that day. That's residual variance. I like to express it with relative strength and relative weakness, basically. Size trends pretty well. So if small caps are doing well for 4 weeks, that's means something. But on the other hand as well. So we had that this year, right? Mega cap was the place to be. So if the mega caps are doing well and the small caps not so well, then that factor trends, size factor trends very well. And long-term reversals as well. So we had that in uranium, for example, in oil from 2020 on. Basically, we had a long-term reversal, and that stuff. Those four factors trend very well, especially if you combine them. So, for example, high beta with relative strength and volatility contraction, which is also residual variance. When the market is higher in terms of its volatility, but high beta shows low volatility and relative strength, then you got a signal. That's basically it.
And let me ask a really basic question here. So your strategy, it sounds like, is to run with the factor until you notice it's not working, right? Like with the size, a lot of people are saying, hey, yes, we've had 7 stocks dominate the S&P 500 this year, or the past couple of years, really. That's a good setup to place an equal weight S&P trade, because that's probably not going to continue. That's weird. That's abnormal. So I want to take the opposite bet, betting on a mean reversion. Sounds like you're not doing that. You say, hey, this is what's working. Let's ride this wave. Yeah, is that accurate?
That's exactly the idea. As hard as it is, but at the end of the day, that's the paper, and I see that also in the market from a lot of tape reading. If those 4 factors show you strength, you got something. And I try to combine those 4 factors in my market timing. Everything else I'm not looking at. So, for example, if you try to time something like utilities, it's almost impossible, because utilities have factor loadings that are more like value, a little bit more quality, and that stuff doesn't trend very well. So that's also the reason why a lot of growth investors concentrate. They don't try to time utilities. They concentrate basically on higher beta growth stocks, because they can be timed pretty well. So that's the reason why I just look at those 4 factors. Right.
Got it.
Okay. So here's the instrument selection per so to say my plots, my buckets where I put instruments in. So everything higher beta is interesting to me. I only use high beta instruments for quad 1 and 3. There are some folks who say, okay, I put utilities in whatever, in the stagflation pattern, in a stagflation bucket. I don't do that, because they don't trend very well, so I don't need them. I need everything that has higher beta, something, and there are some cyclicals as well. Obviously, energy, but there's also something like auto manufacturers and stuff like that. They have a slightly higher beta than the S&P 500, and that's interesting for me. Size as well, so I use different ETFs to capture the size factor, basically, and I use relative strength as residual variance. That's it. Mm-hmm. All right. Okay, so that's we already talked about that. What's important here is basically what's strongest out of the gate after a recent quad change. Oh, you have a pullback, basically. We had that, and I can show that in March, also in January, perfectly, that when you had a bad or a quad 3 or quad 4, and then you get a change to a quad 1, you want to see what's strongest out of the gate. That's very likely that stays strong. The stuff that lifted the market up to a risk on is going to stay strong, most likely, right? Yeah, and unfortunately, the last point here also, microquads can change from week to week. They can have long-lasting trends, but once in a while, you have they can change basically, right? Okay, so that's a perfect example of a quad four, and I'll show it in a minute on the platform on TC2000. So can you see my mouse?
Yep. I see it moving around.
Yeah. All right. So he was the first warning. He was the second warning. And then let's say you said, okay, I'm not going to trust that signal. But in the morning where the SPY was down hard, you had time. This was not the first day. That's the weekly chart. You had time. Basically, I think the first day was something like here. You can basically start to hedge, right? If you,
Yeah.
I sometimes I use the quads right away, so I would be hedged here, or I'll wait for a confirmation. That depends on the situation, basically, right? So let me just switch to the platform here. Okay. Here's my quad. So this is live. This is my portfolio. I'll go over here, and this is live. So you basically see. Let me just go to the SPY here. You basically see to the weekly chart. You basically see we had a quad change this week, right? Last week we had a 3. Let me just do the back test here. I'm going to the back test here, and let me just see. Okay, all right.
It looks like you're in this program basically all day. Is that
Yeah, pretty much. Yeah, pretty much. Yeah, this and portfolio 1, 2, 3, basically. Yeah. So last week we had a. Let me just see, why is that filter not working here?
But broadly speaking, this is the S&P or SPY ETF.
Yeah, that's it.
And we had a quad change last week, you were saying even.
Let me just see. I need a minute here. We might have to cut that out.
No problem.
Oh, here we are. All right.
We're patient.
Yeah. So last week, and it's pretty simple, right? I have those are the higher beta quad 1 exposures, right? Solar, residential construction has a higher beta than the S&P 500, building materials, auto manufacturers, computer systems. And I basically filter them out. That's kind of proprietary, so but I filter them out whether they are bullish trend and have a relative strength high relative to the S&P 500 in that week. So as you can see, this was a 3, and because those exposures in the quad 3 bucket, they were basically stronger, and even quad 4 was coming up. So I basically count them. That's all I do. Say 6, those are 5, so it's a quad 3. It's pretty simple. Let me just go back to that one here, right? The same thing, and I just pretty simple. I just write a 3 above the chart. It's not automated. I do that every week. This is pretty much it. So that was a warning here too, right? So the thing was, I wrote in the blog post, I hedged at the open here, so you can see I hedged here. Then we had a quad 2. I said, okay, this is it. We have the rally, and then I lifted the hedge here at the open, and then basically quad 3 hit again, and I hedged it. That's pretty much it. And once in a while, you get long streaks of good trends, and then I stay basically unhedged, and canceling traders did a killing during that time. And sometimes, as you can see, this hedge here right now is slightly underwater, right? So let me just see. Yeah, it's slightly underwater. So I lost on the hedge on that call, right? So, but doesn't matter. The portfolio is basically flat for the week. Yes, if I would have lifted the hedge basically down here, but I had no indication to do so. So I'm basically waiting for next week. Hopefully, get a little bit of a pullback, and we'll lift the hedges.
This is hindsight's 2020, right? So,
yeah. This is pretty much it. And I backtest. I went back obviously all major market events. So if you look whatever, you look here, right here comes the 4. That's still a 2, and here comes the 4, right? So gold, something like TLT, XLU, utilities, confectionaries, that was strong while the S&P almost made a new high. That's a warning sign. And that's pretty much it. I mean, I went through the whole, basically back to 1998 and tried to backtest every turn of the market. And it's not that it's perfect. I mean, you will have signals that are not that as this week where your hedge might be underwater. You might say, okay, well, I should have been in the market here, but it will not be wrong a long time, right? So, for example, let's just go to 2008, and it'll show another thing that's 2008. Let's just zoom out a little bit, right? Yeah, so that was the high at the high with quad 3, right? In 2007, and this is 17, this is 12, this is 10, so it was a quad 3. So let me just show you what happens if you go to USO here, right? You see that? The market is pulling down, but oil was going up. This is a late cycle, very typical for a late cycle quad. I wouldn't play XLE here because XLE gets dragged down with the market a little bit more, but oil was strong, basically to the last minute until the quad 4 hit, and then oil is not a good exposure there anymore. Let me just go back to the SPY here. If you see here, the quad 4 hits. Let me just see if I did it right. Yeah, see that? Quad 4 is the strongest. And then if you go back to Uzo, that's exactly a week later or 2 weeks later, it broke down with the market. So that's what I mean with being strong out of the gate. So if I go back here to that 3 here, or was it? Was somewhere here, right? Here's a 3. And so what is strong? What defines that quad? What is strong out of the gate will stay strong. That's kind of the bet you're taking in that moment in terms of network momentum, right? Let me just take that one here.
And in a moment, Andreas, I want to ask you kind of a broad, kind of stepping back question as well, but I'll let you.
That's it. Again, this is the example, right? So again, quad 3, and then boom. That's kind of the idea. The same thing. Let me just show you. March this year was just so great. Let's go to January. That was a quad 1.
Mm-hmm.
Right? It was an improvement. You had 3, 4, 4. 3 is an improvement. That's the moment where you really have to pay attention. That's already an improvement. That's good. And then you have quad 1. And now look at residential construction. This is perfect. If you see something like that, that's exactly what you want. The S&P 500 pulls down pretty hard, and then you see, okay, it is a quad, and then you look up basically what is strong out of the gate. That thing here, and that's been strong the whole way. This is the Russell 2000 down here, right? Russell 2000 pulling back hard, and this is not a blip. This is called relative strength and also a volatility contraction pattern. That's what you want to see on a stock or an industry group or basically on an ETF. Yeah, that's pretty much it. Yep.
Yeah, that's textbook right there. So let me ask you this, Andreas. Just stepping back, even kind of broader than the presentation itself. There are probably 2 types of people watching this. One type are familiar very much with what you're doing. They've probably tried their own systems and tried their own factors and can follow precisely. There are probably some beginners too who say, I'm kind of factor curious maybe, but I'm not an expert. My question would be, to those people who are seeing this, who are intrigued, and obviously it's worked for you. I mean, you're retired and I'm not, basically. So that's fantastic. Who are saying, okay, this sounds cool, but like, how do I get in the game? How do I start with this? Like, what are the initial steps? Like, what's your response to that crowd?
Wow. I mean, you got to be really sure that you want to do this. I mean, I have a lot of friends, and I've got one very good friend, and he's kind of a situation like me. He wants to retire. He's got the money, and he wants to go basically into trading. And I always say, don't do it if you are not really love that game. It's tough as hell. Don't underestimate it. I mean, I have bad weeks. I have bad beats also, and it's not something that you don't do when you don't love it. Yeah, it's kind of, we have the word in German Leidenschaft, which is suffering and at the same time wanting to do it, loving it. That would be really the first thing. It's I mean, when I did this 4 years ago, I thought I had it all figured out, and I didn't. And I'm still learning every day. The learning curve doesn't stop. So that's, I think, a really big thing. You have to love it. You have to want to learn every day. Being really flexible, and then being really curious. And what I always say: strong opinions loosely held for 1 week until the plot changes. Stuff like that. So it's a tough game, but only do it if you really love it. Otherwise, I would just say, hey, cost average into the S&P 500 or cost average partly into the cubes, the Nasdaq 100, and cost
Yeah, there are
average.
plenty of like kind of low effort ways to invest, and for most people, that's all you need. And that's a great advice. I mean, if you're 40 years old, let's say, and you've been exposed to a lot of different styles of investing, and you haven't like latched onto this by now, like it's probably not your thing. To Andreas, your point, if you're a young person and say, oh wow, this clicks with me, like you'll probably know if it's for you. It's probably a self-selection thing, I'd guess.
Yeah, I'm not sure whether it's dependent on your age, but the thing is, you really have to want it. You really have to love it. The competition is huge, and find a niche, and that's always when I talk to. I mean, I have friends in my network who are trading. They day trade the S&P 500 futures. I always say you're doing something extreme.
Wrong stomachs. Yeah.
Never do that because it's. I mean, swing trading, okay, that's something else. You could use quads doing this, but you have to find a niche basically where those factors work. I think that's in the area of small cap value momentum. I would start with Portfolio 123. They have a great platform. They have strategies that are already done. You can use them for nothing.
Yeah, like ready to go. Yeah,
ready to go stuff. And then you can fine tune it. But it's you really have to love it. Otherwise, I would just say, hey, cost average into the whatever into the S&P 500. And if you want to use the quads. Follow my blog, and you might want to put on hedges, whatever. There is a quad 304. Okay, that's might be okay too, but otherwise you really need to love the game. Yeah,
that's a great point. And that was my final question is, if someone's watching this at home and say, okay, great, I want more of Andreas specifically. I feel comfortable with him. Where would you have them go? And it sounds like search for Max Quant Strike on Substack. That's the best place?
Yeah, or you can find me on Twitter. Just pump in the name Himmelreich and you'll find me. You can shoot me an email or contact me on Twitter. That's absolutely fine. I have a big network. I have everybody in my network. Futures traders, factor traders, and it's a lonely job otherwise. So
yeah,
I like to interact with a lot of people.
Well, Andreas, thank you so much. You've been very generous with your time. I'm happy for you. This is working for you. You found something that works, and you're doing it. And for someone new to this, again, it's about taking the emotion, taking the common sense sometimes out of the trading, and following the system. And that's where the real common sense is. Because as people, we're not hardwired to be good investors. We're wired for a deterministic world. You touch one cactus, it's prickly. You touch another one, it's prickly. You see a third one, it's probably prickly. Economics is a social science. It doesn't work out like that. So really hard for our brains to get that. So that's the wisdom of these models. So anyway, with that said, Max Quant Strike, you can check out Andreas or search for him on Twitter. I'll put a note below the video as well with links to his places. Andreas, thank you one more time for joining us, and thanks as always to you guys for watching at home.
Thank you.